Good evening, members. I, on behalf of the Management Committee, welcome you all for this study circle meeting on the topic ESOPs, Beyond Basics, Structuring, Benchmarking Practices, Cross-Border Hurdles and Taxation. And to handle this, we have CA Sumanth. May I request Chairman Manjunath Harusa to escort the speaker and present him a floor of the Thank you, Chairman sir. Members, I have a privilege to introduce today's speaker, CA Sumanth Vankayala. Sumanth is driven by the passion for finance. Sumanth started his professional journey as a management trainee in corporate finance at Tata Boeing Aerospace Limited. Sumanth is a senior associate in the finance support team at Agrada. He endorsed to contribute and strengthen his practice in transaction advisory, business consultancy, and structuring towards servicing Agrada's clients. Sumanth is a chartered accountant and a commerce graduate. With this brief introduction, I present before you the speaker, Sumanth. Sir, over to you, sir.
Good evening, everyone. Hope you might be thinking he got drenched. So that's how God plans everything. So actually, I did not think, 15 minutes back, I did not think that I'd be able to attend the session itself. But somehow God sent me some person who helped me to reach here. Many things happened on the way, like my vehicle got broke down, and so it was a roller coaster ride, I have to say. So nothing to worry. We'll start this session now. So thank you to Padguru Bakshi sir for your kind words. So without any further ado, so how many of you all here are employees or have been employees in the past? Oh, I expected a huge number, but yeah. So, as an employee, what makes you motivated to work or increase your productivity? Sorry?
Compensation.
Compensation and?
Only compensation.
Only compensation? Nothing about for compensation? Yeah.
Recognition.
Recognition, yeah. Correct.
Balance.
Yeah. Work-life balance. Yeah. Yeah. So, an employee can get incentivized in both the ways, like monetary and non-monetary. When it comes to monetary, there are many ways in which an employee can be incentivized, like by giving him the bonuses, by offering him co-partnerships, by offering him commissions, and you can also set some goals and you can incentivize employees. And one of all those monetary incentives, one of it is employee stock option plan. Employee stock option plan is one of the stock incentivized plans, long-term stock incentive plans. There are other stock incentive plans also as well, apart from employee stock option plans that we are going to discuss later. However, there are also non-monetary incentives, as you mentioned, like work-life balance and some career development. You can progress the employee's growth by offering him career development opportunities, by giving him flexible working hours, and also by providing recreation activities. So through all these, employee gets incentivized. But of late, there have been a new concept which has been implemented, which is nothing than apart from these non-monetary incentives, which is nothing but employee stock option plans. So we'll see how employee stock option plans have evolved over the years. So first, In 1970s, there has been one economist who is named Louis Kelso, who developed this employee stock option plan, and she made employees owners. And then 50 years back, US government has recognized this employee stock option plan, and then 25 years back, our city has regularized this employee stock options. And recently, we have seen income tax authority also making amendments with respect to stock option plans. So, without a further ado, we will see what are the employee stock option plans and other stock incentives. So, how many of you know any stock incentives apart from employee stock option plans? SARs, correct. RSUs, yes. ESPP, yes, correct. Any other? Yeah, and one more, like you all mentioned, those are all the other stock incentives, like employee stock purchase plans, phantom stock options, RSUs, sweat equity shares, and there comes the SARs. So before we decide on which plan to choose, we'll understand what is ESOP first of all, and then we'll go why ESOP is better than all these plans. So, what is an ESOP? Is it a right or an obligation for an employee?
Right.
Yeah, correct. So, it is right but not an obligation to an employee to purchase the shares of a company at a predetermined price in a future date. Correct? So, what is the life cycle of an ESOP?
Plan preparation, grant, exercise period,
Yes.
investing period, exercise
Correct.
period.
Correct. So, like sir mentioned, a ESOP goes through various stages, where it starts from formulating ESOP plan, ESOP policy, and then granting employee stock options, and then there is a certain period where the ESOPs have to be vested, and that is called vesting period, where an employee is asked to satisfy few conditions, that is called vesting conditions. Vesting conditions can be two, either performance based or time based. So in time based, we will ask the employee to serve X number of years to get the options, to get the shares of the company. Whereas performance based, let's say the revenue of the company should go from 100 crores to 300 crores. So this might be the performance condition. And also company's value should go from X to Y. This is also one of the performance condition. So all these are vesting conditions, as you all know. And there comes, after the stock options are vested, there comes an important activity called exercise, where employee exercise the options and get the shares. This is called, the period between vesting and exercise date is called exercise period. So if you have seen, there are almost all 5 to 6 steps, and our CA community has many things to add in this entire life cycle. Like if I have to tell the importance of ESOPs, if you see, KPMG has made a survey in 2021 where it mentioned that 68% of 200 startups have implemented ESOP or trying to implement ESOP. And there is also one more survey which is recently done in 2024, which told that 78% of the startups have implemented ESOP, which is an up from 59% in 2021. And also, 1/3 of the companies which they surveyed have given ESOPs to all the employees. This number has gone up from 25% in 2021. So from this we can understand how employee stock options have been a productive tool for employees in an organization. Correct? So we'll understand few nuances in entire ESOP cycle. Like I mentioned, investing period, there are few terms which we may not come across during our day-to-day life. So the first one would be cliff vesting. Can anyone tell what is the word cliff? A part 50%, correct.
Taking many steps.
No, it's,
5% after 1 year, 50% after.
no. That is completely opposite. Yeah. Any try? Okay. So the word cliff means waiting. So cliff vesting is a process where employee has to wait till certain period and he will get stock options only on a certain date, rather than gradual vesting where sir mentioned that he would get 25% at year 1, 25% at year 2. That is called as graded vesting. So these are the two types of vesting. One is cliff vesting and other one is graded vesting. So I have one incomplete table. I want you all to fill the table. So like everyone understood what is cliff vesting and what is graded vesting, right? So these are all important because whenever we are suggesting client, we are responsible for framing ESOP policy. In framing ESOP policy, we need to tell them what should be the vesting condition, what should be the vesting period, what should be the exercise period, what should be the exercise price. So these are all very important to understand what each term affects the ESOP policy. So, like I said, cliff vesting means he will not get shares until a certain time and he will get all the shares at a particular date. Whereas graded vesting, he will get 25% over the years. So, like for the first one, vesting events. So, in case of cliff vesting, how many vesting events there will be? How many vesting events? One, correct. And in graded vesting, multiple, correct. And when it comes to admin complexity or record keeping, which is easier? Cliff, correct. Which is very tough to maintain. Graded vesting. So that's why when we suggest clients, so we have to keep all these points in mind so that these are not very objective, these are very subjective and it differs from client to client. We can't straight away tell, okay, cliff vesting works for you or graded vesting works for you. So based on the client's objectives, we need to understand and we need to suggest whether he wants cliff vesting or graded vesting. So may I know what drawbacks would cliff vesting have? Exactly. So if cliff vesting is longer, let's say if it is 3 years, so he will think that, okay, why I have to wait for 3 years to get the shares and I have to exercise. So this is one drawback. However, there is a catch here where, sorry, they can hold on, but he has to wait till that period. So he would not be motivated to wait till that period and he would say, you give me cash instead of stock options. And also he will think that, okay, I have been there for 1 year. Let's say the vesting condition is 3 years, cliff vesting. I have been there for 1 year. So I would have gotten some 33% of the shares. He will be thinking that, okay, I have risked that I may lose the stock options after 1 year. So he may not be that motivated to choose this employee stock options if it is cliff vesting. But there is one catch here, like I mentioned, Companies Act inbuilt gives that cliff vesting of 1 year. So it says there should be a minimum vesting period of 1 year. So that is one point which we need to meet across all the, irrespective of whatever the client it is, whatever company which we are serving. So the minimum vesting period should be 1 year. Like I mentioned, few points to be noted here is cliff vesting is good from company's point of view, because why it is good is, let's say if an employee comes, he just comes to take the stock options and leave. So in those cases, it is not good from employee perspective and also mainly company perspective. So cliff vesting is always good from company's point of view, but not from employee's point of view. So now we'll go to a concept which is completely opposite, which is called as accelerated vesting or immediate vesting. So why do you feel accelerating vesting is needed? Let's say while I was drafting an ESOP policy, I will say first, okay, if you serve some 4 years, I will give you 100 options, 100 stock options. Now it is important to have accelerated vesting in few cases. Why do you think accelerated vesting option is needed?
Above expectation performance.
Above expectation performance, but this is time based.
But can it even happen? Is it 1 year is mandatory?
Yeah, there might be few. That's what I will get into those, but it can happen. Yeah. So, in what scenarios you can imagine why accelerated vesting is needed?
Maybe year-end bonus. Year-end bonus they club to the senior management saying if they achieve say such amount of profit, so they will get promotion on that ESOP.
That itself is employee stock option. Means if
They will get it immediately if they achieve say 20% profit.
that has to come to formalized ESOP plan which is approved by board. Once he achieves abnormally in a year, we can't give that ESOPs all of a sudden. So I will get to the stages, events where accelerated vesting is needed.
Mergers, takeover.
Exactly. So the events where accelerated vesting is needed is, let's say I served for 1 year in an organization. Let's say my vesting condition is 4 years. I have vested some 25% of the option, and my vesting condition is such that every year 25% of the options will be vested, and it is not cliff vesting, it is graded vesting. Now let's say at 25% I will not be able to, or some emergency has happened or some employee has passed away. So it is an emergency situation and he can't serve the period. So considering that, board of directors may consider and give them accelerated vesting. And why do you think in an M&A situation accelerated vesting is needed?
So that employees are rewarded.
Okay, when it comes to the acquiring company, they will give their options, right?
No one wants to put the liability while merger is happening. So after the merger, that liability should not be there. That's why
And the control changes.
Coming to control changes is one of the reason, because let's say I run a company called X. I run it for 25 years and I know how the employees are, and I know how they perform, and I know they are so trustworthy, and I told I will give them the options. Now let's say that when the management is changing, I don't know whether they will treat the same person as how I treated, and he will not be loyal. So this is one reason why in M&A situations or a situation where change in control is happening, accelerated vesting is done, which means that your all unvested options will get vested on the same date when the decision of accelerated vesting is taken. And one more reason could be termination without cause. When you are terminating an employee without cause, he would also expect a reason, but you are terminating without telling any reason, then you would expect that all the options would be immediately vested. So this is good from whose point of view? Yeah, correct.
This should be a part of ESOP plan to be implemented.
Yeah, so how it goes is, let's say when I'm drafting ESOP policies, there are trigger events. Let's say in the case of death or disability, in the case of M&A situation, in case of liquidity, in case of M&A or strategic acquisition. In all these scenarios, we need to frame it in ESOP policy saying, okay, how will you treat the unvested options? How will you treat the vested options? How will you treat the excise period? So all these have to be notified in the ESOP policy event-wise. So the other concept is excise period, excise price and excise period. So why do you think excise price is needed? Now let's say am I audible, right? Yes. It's fine if I don't use my phone. So yeah, let's say the cash component of salary is 10,000. I wanted to. If I'm audible, that's fine. Am I audible? So, why do you think exercise price is needed? First of all, everybody is clear what is exercise price, right? Exercise price is something you need to make a payment to the company to get the shares, correct? So, let's say I wanted to pay 10,000 salary to the employee. So I can pay without taking the exercise price, right? Let's say 10,000 is the compensation which I have to give him in cash, but I'll say, okay, I'll not give in cash, but I'll give through options. Let's say the company share value is 100. So 10,000 divided by 100, I'll give 100 options. I can give directly 100 options saying value of the company is 100 and you are getting 100 options. So ultimately you are getting 10,000. Why do you want to take something from the employee and again give more options which will lead to more dilution? So let's say now if you are taking 20 rupees from him as exercise price, so you are giving ultimately 80 rupees per share as a benefit to him. So you need to give more number of shares. When you give more number of shares, your company, the holding in your company would dilute. You are getting what I am trying to tell, right?
Yes.
So why company wants to get into that situation?
It's a benefit for employees.
For employee, how it could be benefit?
Like
Exercise
if
price
they're
will
getting
reduce the cost of the
so
options.
benefit for employee, right? They are getting 100 rupees share at 20 rupees.
No, no.
As a proposal to employee, the exercise price.
100 rupees share, they have to pay 20 rupees to get 100 rupees share. Why? I am asking why they need to pay 20 rupees.
Is it a normal practice that there will be exercise?
No, that will reduce the value of the options.
So let's say this is more prevalent in listed companies, but as you said, it is a common practice in listed companies, but not in unlisted companies, because of two reasons. One is when you keep exercise price, you will get less benefit, and also in case of unlisted shares, there will be very less liquidity. And when you are reducing the benefit to him at the upfront only, so he will not be able to liquidate his shares, and he will be it is very difficult for him to get the benefit. Whereas when it comes to listed shares, let's say Infosys has given options when the fair value of the company is at 1,000 rupees, and I want to track the performance of the employee from now till next 2 years. So whatever benefit you want to you get through the share value. So if you put more efforts, you will get more value. So I will put my strike price as, exercise price as 1,000 rupees, and over and above whatever you achieve, that is about your efforts. So that's the reason, that's one of the reasons why exercise price is prevalent more in listed companies. Why it is not prevalent is in unlisted companies is there is no valuation. So we need to do at multiple stages, we need to do valuation of the company, which is not that easy whenever more options are issued to employees. And also there are psychological impacts, like one is if anyone gets something for free, they will not be motivated or they will not be more productive. So to give the sense of buying the option or share, exercise price is recommended, and also risk alignment with shareholders. So existing shareholders would have already paid some amount to get into the cap table. So to align the financial risk of the employees, so we will recommend exercise price, let's say up to face value. In some cases, we will recommend nil exercise price, because that may that will help the company to maintain the stake. Is everyone clear why exercise price is important?
So exercise price can be zero as well.
Yeah, exercise price. So if you go in deep, companies that doesn't allow shares to be issued at a discounted to face value.
But exceptions are there.
Yeah, so companies rules specifically provides exception, saying that you can company is free to put exercise price whatever it feels according to the accounting standards. So it can be nil. So that is the common practice to have nil in case of unlisted companies. So next concept is with respect to exercise period. So what is the importance of exercise period? Yeah, so how will it impact an employee or company is, first one, again the same thing, cap table, like if you have long exercise period, your dilution will differ. So it is good from company's point of view. Second one, if you have a short exercise period, let's say I have exercise period, shorter exercise period without any liquidity event. Let's say I have vested all the options and have to exercise the options to get the shares. So when I get the shares, I have to, I will explain in detail about the taxation of the ESOPs in detail. But the first taxation event in case of ESOPs is when exercise of options happen. So I will tell, okay, I will exercise my option and I will get the shares. So at that point in time only I have to pay tax, but I will not get cash. So an exercise period without liquidity event would lead to financial burden for an employee. So if you have a shorter exercise period without a liquidity event, it will be problematic to employee. When it comes to longer exercise period, it will be benefit to employee in such a way that he can track the movement of the share. Let's say at the time of exercise, the company share is at the least. So he need not exercise at that point in time. Why he has to exercise and then pay tax when the company share is at the lowest point? Rather, I will exercise when it is at the peak, and I will pay tax and I will realize. So these are the nuances between having a shorter exercise period and longer exercise period. What are the various types of exercise period? Like in case of vesting, there are two types of vesting, right? So cliff vesting, accelerated vesting. So in the same way, there are various types of exercise period. So those are immediate exercise. So immediate exercise, graded exercise, and there is a new concept called post-termination exercise period. So let's say when it comes to immediate exercise, as and when the options are vested, they will immediately exercise into shares, and he will get the shares and he has to pay tax and he has to pay the exercise price. This is immediate vesting. Whereas graded vesting, company will open the exercise windows on a timely basis. Let's say every 6 months after the options have got vested, they will open exercise windows where employees can sell their options and get the shares back. Is everyone clear? And post-termination exercise period. So why is post-termination exercise period needed? And few companies intentionally keep post-termination exercise period as very short, which is not recommended as a good practice. Let's say I have the options vested with me. I have the options. So the options are mine only because I served for 4 years and I got the options. Now I am leaving the company. Company will say that, okay, since you left, you exercise the options within 90 days, which is very bad on the part of the employer, because you are asking the employee, he is not giving the freedom to the employee to exercise at whatever time he wants. So recently there has been many controversy around this concept, and many startups have started using a concept called infinite exercise period. So once they leave the company also, they can have infinite time period to exercise their options. So before going to the next concept, we understood what problems would employee face at the time of exercise, right? So he has to pay exercise price and he also has to pay tax. But he is getting only shares, he is not getting cash. Let's say I am a mid-level employee, you are giving me shares, but I have to pay tax on shares and also I have to pay the excise price. I don't have cash. So how will I be able to make those payments? So this is a problem, right?
Exchange reason.
Sorry? Yeah.
Exchange reason.
That has been amended only for startups, only a few startups, but since ESOP is prevalent across all the companies, not only startups, so this problem still lies for other companies as well. So how do you solve this problem is through cashless exercise. So cashless exercise can be done through three ways. One is cashless exercise through trust, cashless exercise through fund houses, and ESOP funding by the company. So in cashless exercise through trust, what happens is company gives loan to trust, which is created by company itself. Their directors would be trustees. The trust purchases the shares from the company, and as and when the employee satisfies the vesting conditions, they will exercise happens. Trust will transfer the shares, and immediately employee can sell the shares to the trust and get the cash. Why can't company only directly purchase from the company is what the question you might all have. Like why trust is being a part of all this exercise. Like I said, trust will purchase the shares from the company and trust will issue shares to employees. And trust will sell, employees will sell the shares to get the cash. So why not company only
Company can't hold its own shares.
yeah, buyback. So there comes the concept of buyback, but buyback again there are many restrictions like 25% of reserves. So all these nuances will be there. That's why company would not do it directly. That also is an option, but if trust is there, it would be little easier. So the next one would be cashless exercise through fund houses. So there are many fund houses which says that okay employee, you can exercise the options. I will bear the exercise price and tax cost. So to that extent of tax cost and exercise price, you sell the shares to me, I will sell the shares to company and I will realize the money. So you can take the remaining shares. This is a cashless exercise through fund houses. The next one is ESOP funding by company. So company will give loan to employee and employee will pay the excise price and pay taxes and get the shares. So now everyone understood the basics of ESOPs and the terms which are used in ESOP, right? Any questions till this?
When you read the annual report, you will always find there will be forfeited ESOPs.
Yeah.
That means the employees has not exercised. Now when these are available, trust or fund houses or all these are available, and it will be always be that the market price will be more than the exercise price in case of listed companies.
Okay.
Mostly.
Okay.
Why would the shares be forfeited? Why would the company forfeit for not exercising by employees?
So if he is only not exercising, then
No, the reason why the employees will not exercise. Don't they take the salary? This is like a salary, right? It's a part of remuneration.
so one reason could be, let's say, like I mentioned, one of the main issue would be if he gets the shares. That issue might be more in unlisted companies than in listed companies.
No, even if you read the listed company annual report, it's a regular feature. I mean, it's not major.
Yeah.
What is the ESOP granted and vested? It is not major, but always you will find forfeited ESOP.
Okay, one issue which I can see immediately is, let's say I am paying some X amount to get the shares. Let's say I am paying Infosys share value is 1000 rupees and I am paying some 800 rupees as excise price. Now I may feel that I am paying some 800 rupees. What if Infosys shares comes down 800, below 800? Then why will I choose to exercise the option to get the shares?
Long-term holding.
Yeah. Either he should have a, let's say, he can hold for long term to get the share price to some X level, like 1200 or 1300. If he doesn't have that patience, then and if he thinks that company's value would come down, he would forfeit the shares because he would not get any benefit from it.
These are the ways we can hold the ESOP pool. Is that what it means?
Sorry, I did not get.
These two trusts and fund houses, is that how you can hold the ESOP pool in the company?
These are not the only ways. Like fund house doesn't ever hold any ESOP pool. Trust might hold. So ESOP pool can be managed either by the company directly or through trust. So company only can manage all these by issuing options to employees and then exercise events. All company only can manage through its own. But if they wanted to give some benefit to employees for cashless exercise, they can put some trust in between as a special purpose vehicle, and they can implement this. There is no hard and fast rule to have trust to have this implement this ESOP. Rather, trust is very difficult to implement for a small companies. This is trust is seen majorly in listed companies. It is not most widely used in startups or mid-sized companies, because you have to set up trust. You need to again maintain books for it. It would be very beneficial for listed companies because they can outsource their entire ESOP recording to separate, like they can manage through a trust. So now we understood ESOPs, right? Now let's understand why, what are the other stock incentive plans, and why ESOPs are more prevalent than other stock incentive plans. So the first one is employee stock purchase plans. So this is not that prevalent in India. Like if you see, you can count on numbers where companies are choosing this employee stock purchase plan. When I was in my experience, like only Wipro has once implemented this employee stock purchase plan, but there also many employees did not exercise this option. And we don't see most here in India this employee stock purchase plan. So what does employee stock purchase plan means? So it is like an SIP where employee contributes an X amount of his salary to purchase shares at a discounted price at a later point in time. Let's say I will contribute 10,000 every month from my salary to purchase company shares after 2 years, after satisfying my vesting conditions. So why it is not so prevalent in India is, again it comes to point between listed and unlisted companies. So whenever I have to purchase, company should issue shares, right? And whenever company issue shares, valuation has to be done. Every point when issue happens, a valuation report is required. So it is easy to get valuation report for listed companies. However, for unlisted companies, it is not that easy to get a valuation report because rigorous exercise is needed to identify the value of unlisted companies. So this is one main reason to identify value at each point of issue, because there will be hundreds or thousands of employees. So it is not that recommended to have this plan. And one more main reason is, here in this plan the discount would be majorly between 10 to 15% where employees are allowed to get the shares. So let's say after 2 years, you will be getting shares at a discount of 10 to 15%. So you will not get much incentive in employee stock purchase plans. So when it now next with respect to phantom stock options. So what are phantom stock options? Phantom stock options are nothing but they are also called imaginary stocks, or they are also called virtual stocks. So it is nothing but a stock appreciation right which is paid in cash. Let's say when I am giving option to company, the option the company's share value is 100 rupees, and I will say in 2 years how much ever there is a appreciation in the value of the company share price, that much I pay through cash, which is nothing but stock appreciation right paid in cash. Is everyone clear with this phantom stock option? So why do you want to give in cash?
No dilution.
Exactly. The main reason why you want to give phantom stock option is you will not dilute your capital, and also you will be achieving the same objective of making the company, making the employee take the ownership. Because he is getting his incentive based on the stock price, or he will be imaginarily he will be an owner of the company, but he will not be owning the shares. And one more reason is, if there is no clear exit strategy for the company. Let's say when employee gets the shares, generally in ESOP, the excess event is linked to liquidity event. Liquidity event, when I say liquidity event might be M&A or strategic acquisition or IPO. So why do I want my exercise event to be linked to these three events? Yes, exactly. So that I can tell the employee, okay, I will link your exercise event to these three events, so that you can realize your shares immediately through those events, IPO or M&A or strategic acquisition. So this is one way of how you can solve the employee's problem of taxation and excise cost, cash flow issue. So to solve this, if company doesn't have any visualization of the liquidity events, if it doesn't know when it wants to go to IPO or strategic acquisition or M&A, and it wants to give cash, but it is not getting solved through ESOP, they will give directly phantom stock option. Yeah. Yeah. Listed companies can also give.
Can you be happy because if unlisted company will not be able to assume the fair value, how much is profit?
It would be sufficient to value the company share.
What is the legal framework for
Companies Act is silent with respect to phantom stock options. SEBI has regulations, but Companies Act is silent on phantom stock options. That's a good question, actually. Yeah.
And these phantom stocks can be given from other than employees also?
Yeah, it can be given. It can be given to advisors or consultants. Any question? Okay. Now we'll move on to the next question, like in choosing the type of stock option plan. One more most prevalent in other Western countries or Europe, there is RSUs, which are restricted stock units. So what is the difference between ESOPs and restricted stock units, if anyone is aware of restricted stock units?
The well-established companies come up with RSUs, the stable companies basically.
Correct.
And as far as what it is like, it will be vested immediately, right? There is no waiting period, and also it will be given free of cost if I'm not wrong.
Yes. So why do you think well-established companies only give RSUs? So the main reason of giving, first I'll tell what RSUs. The major part of your answer is correct. So RSUs, like in ESOP, there are three stages, right? Grant, vesting, exercise, and then shares. In RSUs, there is no step called exercise. So once you vest, you will get your shares immediately. So it is very simpler to implement. So why not every company is issuing RSUs? Liquidity. How employees get that issue would be there in ESOPs also, right? Yeah, but
It's not tax efficient for employees.
yeah, that is one point. And also, if you see why well-established companies issue is their main motive would be to retain the employees. So retain the employees, and when you're not expecting anything, nothing from the employee, not from performance point of view, you're expecting only the employee to stay. So when the employee satisfies the time condition, that 4 years or 3 years, he will get immediately the shares. So irrespective of his performance, he will get his shares. So the main reason of giving RSUs is other than performance. If you want to retain that employee, irrespective of his performance, if you want to retain that employee, companies can opt for this RSUs. Whereas in ESOPs are mostly used by startups because to hire talent who wanted to take risk. So you might all think that irrespective of performance, while I am getting RSUs, it is more beneficial for me to, from an employee point of view, it would be more beneficial. RSUs might be more beneficial than ESOPs, correct? Will anyone disagree with the view? Taxation in RSUs it might be a problem, but in ESOP also it is not available. It will get deferred, that's it. So in one, we'll see one example where stock options are better than RSUs. Let's say I am giving, I wanted, let's say his package is last employment package is 10 lakhs. So now I am saying I will give you 8 lakhs and 2 lakhs in salary, like 2 lakhs in stock options. The 2 lakhs is being divided among 2 lakhs divided by how many number of per share value of the company, those many options I will give it to the employees in RSUs. Let's say 2 lakhs divided by share value of the company is 100 rupees. So I will give him the 2000 options, 2000 RSUs. So the company share value has gone from 100 to 200. So he will, how much will he get? 100 options into 100, he will get 1 lakh benefit, so 2 lakh benefit, correct, in RSUs. Whereas in case of ESOPs, which has excise price, 100 rupees is the share value of the company and excise price is 20. Let's say excise price is 20. So the net benefit he is getting from each share is 80 rupees. However, I want to give 2 lakhs. 2 lakhs divided by 80. How many options will he get? Much more than what he is getting from RSUs. So he will get more than, there he would be getting 2000, he will be getting here 3000. So when 3000 options are deriving, when 3000 options increase, the value of each option increases from 100 to 200, that he will get benefit on more options. So in this way, employee is getting more benefited from ESOPs than RSUs. Because it is all about number game. In ESOPs, he would get more number of options because he would be paying excise price. Whereas in RSUs, he is directly getting the shares and he would be getting lesser options. Am I clear?
It's generally a population because RSUs he can sell and invest in the estimated period, so that it will be ESOP he can carry.
ESOPs he can hold on, like he can hold on the options and he can access whenever he wants.
No, as soon as it is vested, RSUs he can sell. But ESOP he has to wait till the exercise. At the exercise, he has to wait till the vest period for ESOPs. But RSU he can sell immediately and pay the tax and then retain the ESOP.
For RSUs also, that's what RSUs is more prevalent in well-established companies and listed companies, where you have liquidity to sell the shares which you got immediately, and that is very easy in listed companies. Whereas it is not prevalent in unlisted companies, as you said, there is no liquidity. First of all, for unlisted shares, so it is not beneficial for me to hold RSUs. Once I get the shares, I have to pay tax at one end, but there is no liquidity for my company. So it is not beneficial for an employee. If you see only from this point of view, RSUs are not beneficial from taxation point of view.
There is also a restriction, right? You can't sell RSUs immediately. There also there is a holding period after which they become free to you.
Yeah, you can do either ways. Like you can have a restriction, you can have a lock-in period, and you can tell the employee not to transfer. That restriction you can immediately.
I have seen a scenario where even there immediately the stock is issued, but then vest in the sense, in a sense it will vest only after a year.
Yeah, that is possible.
There is a cliff there.
Yes,
also.
yes. That is always possible.
That's why it's somewhere restricted, right?
Yeah. Yeah, that can be possible. When you are restricting, again it will become a similar concept to ESOP only. Correct.
No, but here the shares are issued. You can vote.
Yeah.
You can vote in
Yes.
business decision.
Also, there is an exercise period in RSU also, right? So,
That's
even
right.
if it vests, so there are 3-4 years. Which is like,
No, he will get the shares immediately. He can, what sir is saying, we can have a lock-in period for that sell of share.
but if lock-in period is there, it gets taxable, right?
Yeah, that's what.
As soon as it-
That's where again the whole point. Yes, sir, you
No, I was just saying, vested, both vested together, so he can sell the RSU, but he can then take the money and invest in the, whenever he wants to exercise for the ESOP.
yes. Did you all understand like how ESOPs might be beneficial from employees' point of view when it compares to RSU? So another stock incentive plan would be sweat equity shares. So what is a sweat equity share?
Consultants, and whenever they start the company, if you cannot pay too huge fees to consultants and all, they get sweat equity, whatever the work they are doing, for that they will get the sweat.
So sweat equity shares are issued to employees and directors for their contribution till date, which is like consideration other than cash. So when do you want to issue sweat equity shares over? When do you choose sweat equity shares over employee stock options? So it is clear, right? Like I am directly issuing shares, which means that I am giving the benefit upfront. Like if sweat equity shares are mainly given for the past services, whereas ESOP is given for the future obligations. Like future you have to serve for X number of years. In future you have to make the company's revenue from X crores to X crores. So for all the past services, and when you want to reward that employee immediately, you would not go to ESOP because ESOP would have a cliff period of 1 year, mandatory cliff period of 1 year, and it would take longer time for the employee to get rewarded. Whereas in sweat equity shares, you get the share, he will be issued shares directly, and expense will be recorded in the company.
But in case of sweat equity, you need to value the service received also.
Yes. Yeah.
It is not free of cost. It is considered as a consideration other than in.
Yeah, sure. It is consideration other than that. Otherwise, you company will not be able to get taxation benefit, right? Deduction benefit. Leave about employees.
True, but in case of ESOP, you don't have to value the service received.
Yeah, we need not value the
You
service.
need to value the company
Yeah.
or the shares. In case
So
of
in ESOP also you value and record the cost
Yes.
every year.
Yes.
What is the economic benefit derived to the company? That is the value that we have.
Yeah. So it is like if you are not able to value the fair value of services received, then accounting standards only give an option whichever is more reliably measured. So if you are not able to value the services, so you can value the company shares and you can record the expenditure.
Generally given to who are not employees, directors are not employees, or consultants are not employees. It's not given to employees.
It can be given to employees.
It's not given. In which case can it be given to employees? They will be given RSUs and ESOP. Why would they be given certificate?
But let's say he has served from in past 20 years. So why not I give where he will be immediately get benefited from the shares of the company.
Name itself suggests it is to outsiders, consultants and all.
Well, the company that doesn't restrict means you can give it to outsiders, that is allowed, but it is no way restricting to give it to employees.
But doesn't the company side say it can be given only to employees and directors?
One is sweat equity shares.
Right.
To advisors or consultants also it can be issued, which is consideration other than cash. So there it is not called as sweat equity. Here it is called as sweat equity because they are putting their sweat. There it is not called as sweat because some external person is putting efforts.
How will the taxation work? Suppose the professional services are provided is worth of 1 lakh, but the fair value might be 3 lakh. So how will the taxation work?
Like you will value the, there are clear taxation rules that I will get to, there are clear taxation rules there. So we'll see when sweat equity shares versus employee stock options. So when you wanted to cover a broader base of employees, ESOPs are better because it is not advisable to issue sweat equity shares to a whole lot of employees. Like you might get serious, you might get questions from your investors as well. And what is the purpose of ESOP? ESOP purpose is retention and motivation, whereas sweat equity shares is recognizing his past services. And ownership. In ESOPs, he will get ownership at a later point in time, whereas in sweat equity, he will get the ownership of the shares immediately. And dilution in ESOP, it will not get diluted, and it will only get diluted only when exercise event happens. Whereas in case of sweat equity shares, your capital will get diluted immediately. Consideration anyway is cash. He has to pay excise price and he has to get the shares. Whereas in case of sweat equity, it is non-cash consideration. So we are left with one question, that is, what are various modes of compensation available to advisors or consultants? Like everyone was asking whether I can give phantom stocks to advisors or consultants, whether I can use sweat equity shares. So what are the other options? Can all these be given to advisors or consultants? What is your view?
Yes.
ESOPs we can't give, but I will come to that. Remaining can be given. You all agree with me, right? Yeah. So all the other options are also possible where we can give to advisors or consultants. ESOPs are also possible, but that is not called as ESOP, but the same concept can be replicated to consultants and advisors. So it's like, it is not, we cannot take the literal meaning of that, and then it is not act is silent, company act is silent. So how it works is, you will give an option to advisors or consultants, he will exercise the options. So issue of options is nowhere covered in Companies Act. So this is very, only few companies would try to implement this, but yeah, this can also be done. But that is not called as ESOP, but call options can be given, and whenever he is in the money, then he will exercise the option and he will get the shares. But there one question comes in, there GST also would come in, like in all other cases also GST would come. Like in that case, GST also would come for the advisor consultants when call option is being given to employees. Can we move ahead? So we'll see what are the best practices used at each level of ESOP. Like let's say what should be the type of stock. What are the best practices used in industry? What should be the vesting condition? What should be the vesting period? And what should be the pool size? And what should be the exercise price? We'll see what are the industry best practices in each scenario. So, firstly, when it comes to which is more prevalent option is employee stock options stands first India, at least in India, employee stock options are most common than compared to RSUs, phantom stocks, SARs, sweat equity shares. And then comes to timeline for grants. So why this is important is timeline for grants. You can't issue all the options at initially when the company. You can't issue only at one stage. Let's say I will create a pool now only for 25 or 15%, and I will issue some options as and when the employee vests the shares. So this is not a good practice, because as and when a new investor comes in at every stage, he would request the founder to dilute his stake, because the founder has to dilute his stake to create ESOP pool. So it is not advisable to create ESOP pools at only one stage. It should be it should happen at regular intervals. It should not happen only at one point in time. And why it is like if you see in Paytm also, Paytm right before going to IPO, it has doubled its ESOP pool size, and where it stands, like the ESOP pool size now it is 10% of entire capital. So this is where we can take that ESOP pool should be created at multiple points and not only at one point in time. Pool size, we will get into pool size in further slides. Like basically, we'll decide what should be the pool size, whether it should be 5%, 10%, or 15%, 25%. What will happen if the pool size is more than 25%? Now, what should be the vesting period? So, like we discussed, right? Like earlier, like cliff vesting. So, the best practice of using cliff vesting is like cliff vesting. I told there should be minimum 1 year of cliff, which is recommended by which is mandatorily required as per Companies Act. With that, what is the best practice which is used for vesting period is 4 years. So how it works is till 1 year he will not get any options. After 1 year he would get monthly. For next 4 years he would get on a monthly basis. So 4 years with a cliff of 1 year is the best industry practice which is used. And vesting condition, most widely used vesting condition is time based and service time based and not performance based, because performance condition would lead to unwarranted litigations between employer and employer, because he will say I have performed and employer will say you did not perform. So it is very difficult to judge and it leads to disputes. So the most widely used vesting condition is time based vesting condition. And like you would be able to see that some of the best practices which are used by well-known startups, like Urban Company uses 4-year vesting schedule with a clause of accelerated vesting, and Flipkart uses 4 years with 25% of allotted shares with monthly vesting. Like after 1 year, every month they would get proportionate number of options. Meesho also works same as Flipkart, and delivery 3 years from grant date. So 20% and 30% and 50%. So exercise period, like I was discussing in my initial slides as well. What should be the exercise period? Exercise period should ideally be linked to value realization events. Value realization event means strategic sale or IPO or an M&A event where the company is getting cash so that it can in turn disperse it to employees. A merger which has only swap of shares, again it is not a value realization event. So we should be really careful when we are defining exercise period in our ESOP policy. So we need to link exercise period only to a value realization event. Like here I mentioned two practices where Pinterest is giving 7 years to exercise vested options. These examples are post termination exercise period. Like I was saying, it will be harsh on the employee to have a shorter exercise period once he leaves. So there is a shift in this exercise period where Pinterest has been using 7 years and Urban Company and ShareChat have been using infinite exercise period. Like if you leave from the company also, you can have a longer exercise period and you can exercise whenever you want. Exercise price, there has been like long discussion on what should be the exercise price. Till yeah.
Just one question with respect to that infinite exercise period. Won't that create uncertainty in terms of the actual ability of the company with respect to outstanding ESOP or the outstanding options? Sometimes the company may not be able to trace some of the employees. You are infinite period, right? After 10 years, 15 years, you don't know what is the likelihood of that option being exercised. So won't that create uncertainty in the mind of future investors as well?
That liability is crystallized anyways. So there is liability.
Right, but
yeah, that is a
liability is created, but will that materialize or not?
Yeah,
will be uncertain.
That investor, when the incoming investor has to keep that liability in mind and then he has to value the company.
That becomes very difficult for the investor to judge, right?
So
will 50% of the options get exercised? Is it 90%? Is it 30%? We don't know.
Exactly. That's where the concept of dead stock comes in when infinite exercise period is being recommended. So, like it will be some 5 to 10 years, and employee will not exercise, and I will not be able to give that options if he's not exercising. I can give that options to some other person. So that drawback is always there. This is not. These are all subjective, and it can be varied from company to company. So it all depends between discussion between employee and employer, and if employee agrees, then it is well and good, and we can have shorter exercise period. Shorter exercise period also has one benefit. Can anyone tell shorter exercise period? Like I mentioned, the drawbacks only of having shorter exercise period. Like he has to exercise immediately and get shares, and he has to pay tax. So there is one benefit of having shorter exercise period also for employees.
Become long-term capital.
Exactly. So let's say my exercise date is 2024 and the fair value of the company is 100 rupees. If I exercise period is today only. If I get the shares now only, I will pay tax now itself. Now I will pay 100 rupees tax, which will be at normal rates of tax. So it will be treated as perquisites, right? Perquisites will be taxed at normal rates of tax. And whenever the share value increases, I have to pay long-term capital gains. So from 100 to 200, I can pay long-term capital gain. Long-term capital gain rate is 12.5%. If I have longer exercise period and I am not paying tax at the time of shares, I am not exercising now. I just have vested options. I am not exercising now, and I wait till exercise period, longer exercise period. So at the time of exercise period, all this value appreciation which has happened all these years would be taxed as perquisite. It will be taxed at normal rates of tax. Like more appreciation is being taxed at normal rates of tax in case of longer exercise period. So, and the next, so everyone is clear like why shorter exercise period from taxation point of view it is beneficial when it compares to perquisites and long-term capital gains, right? So, locking period. So usually locking period is nothing but they are telling employees that you can't transfer your shares. So usually we will not put that restriction because it will be demotivating for the employees. So that's why we would not recommend a locking period. However, it is very important to have few clauses like drag along, tag along, and right of first refusal. So can anyone tell why these are important? And first of all, can anyone tell what drag along? What do you mean by drag along, tag along, and right of first refusal?
Is for new investors who so already who has invested, we will see that if the promoter or whoever is selling, so he should be able to sell along with them or get more shares along with them, tag along with them.
Yeah, but why is it relevant here? Like, why are you asking that right when shares are issued to employees?
So that the promoters also have skin in the game. You know, because the value of stock really depends on how well the company is doing, and only the promoters who are initially there and managing the company, that kind of value can be generated. If these rights are there, then the investor can sort of force the promoter to be there and run the company, thereby getting a higher value for the shares.
That's not the exact reason, but I'll tell you why these rights are important. Because let's say if he leaves the company and joins the competition, and he's owning shares in our company and he's joining in some competition. So these rights are very important, where the company exercises the right to buy back the shares from the employee when he's leaving the competition. So all these rights like drag along, tag along, and ROFR, right of first refusal, when an M&A comes, when M&A event comes, and everyone agrees, but employees are not agreeing. So how would you execute M&A event? Unless you have an option of dragging, like how that option says, drag the employees to accept that event. So like an incoming investor also would recommend, if normal funding round is there are existing investors and there is a new incoming investors. You would also request the same thing, that I would impose drag along, tag along on existing investors, because when any M&A event comes in the future, I would like to bring these shareholders also to accept that M&A event. In the same way, with existing investors, I would want the employees also to accept for the M&A event.
Is it for the employee? Because employees in any case, once they exercise, they become the ordinary shareholders. No?
They become the ordinary shareholders.
This is only for the investors who are there for drag along, not for employees.
No, this condition can be there for employees as well.
No, one employee is there, where investor is a major investor. So it is only for investors. That is my answer.
It's not a right for an employee, right?
Because they enter into an agreement. They enter into an agreement, no, with a person. They enter into an employee don't enter into an agreement. They are just the employees.
No, if they want shares, they have to sign a deed of adherence. A deed of adherence is nothing but, let's say I am running my company and I have SHA with my investors. Deed of adherence says that whoever new shareholder comes, they have to abide by the terms which have already been agreed in shareholders agreement. My shareholders agreement have conditions like drag along, tag along, and right of first refusal. Like drag along, if any new investor, if any investor is there, he wants to, if any purchase is coming, and I am selling my stake, you also sell my stake. You also sell your stake. So this is drag along. So this deed of adherence has to be signed by incoming shareholders, is what the condition which we will tell upfront in the ESOP policy itself.
No, generally employees are like, I am a shareholder, employees also become a shareholder. They are normal shareholder. There is no agreement.
Exactly, they are normal shareholders. That's why if I will put a condition that if you want to become a shareholder, you sign the deed of adherence. Deed of adherence is nothing but any incoming shareholder, you are abide by the SHA which is already agreed.
I think the issue is, you said it's a right, actually it's not a right to the employee. Drag along
Right.
is not a right. It's
Yeah.
an obligation.
All these are rights to the company. Company or
No,
investor.
tag along can be a right to the employee because he would want to tag along with a major shareholder and not left as a minority shareholder and nothing happens to the minority shares, right?
Tag along can also be a right to the company, because when you are selling your stake to some person and you are getting good valuation, I might, as an investor.
No, not to a minority. You are right. If it is a majority shareholder, if it's an employee, if I am selling a share at 100 rupees, why would the company say that even I will tag along with you because you are selling it at 100. I mean, then it will become like a hostile situation. Whereas a drag along, if larger shareholders are selling, then I would also get pulled, and that's not a right to me. It is an obligation on me.
Yeah, exactly. These are important because the employees should not take this as benefit, and they might control the decision making, which will
So it's a
impact.
right with the company.
Yeah, that's
It's a
right.
with the
All these are rights to the company. These are important for company to have all these rights, because employees, they can have control of only few things, but not entire company. Everyone clear of why these rights are important? So basically, these rights are being covered in ESOP policy itself. So it is very important to draft ESOP policy keeping all these in mind. So there should be clauses of mandatory buybacks. So let's say, like I gave example, when he leaves company and he joins a competitor. So I should have a condition that he has to transfer all the shares to me mandatorily. So all these conditions I put forth front in the ESOP policy itself. So next comes to number of options that have to be granted to each employee. It depends on the stage of the company and what is the cash component. So it depends on the percentage of CTC that you are offering in cash. So all these conditions have to be kept in mind when you are deciding the number of options that you are granting to each employee. Then it comes to what should be the pool size. So how a pool size has to be determined, and how will it impact a company? And when, at what stage, how much should be the pool size is what we'll see now. So, like I already mentioned, founders or promoters should carefully ensure that they are not diluting their stake all upfront, and they should, because if you dilute your stake at upfront, the incoming investors at each stage would want you to dilute more. Rather, if you dilute now less, and at each stage, along with investors, we will also dilute some stake. So that's why we would request our clients not to, like founders, when we are suggesting, we should suggest in such a way that you should create pools at multiple stages and depending on the stage of the company. And why is it important not to exceed 25% ESOP pool size? Can anyone tell?
Listing.
Share
majority.
25% can't be voted.
You won't have special.
Exactly. So when you give more number of shares, more than 25%, it would they will not be they will have the right, and they can whatever special resolution matters which requires special resolution, they will have more control. So that's why it is generally suggested to have ESOP pool size of less than 25%. And usually, if you see, early stage startup would have 10 to 15% of their cap table as ESOP pool, and then Series A/B will have 7 to 10%, and growth stage startups would have 5 to 7.5%. So when I say the pool size is reducing, if you see from stage to stage, the pool size is reducing. Does it mean that the number of options are reducing? Correct.
Cannot be, because the cap table is much larger.
Yeah, exactly. So when I say the percentage of pool is reducing, it doesn't mean that number of options are reducing. Just that the company's valuation is increasing. That's why ESOP pool size will reduce as and when the company goes big. So the ideal ESOP pool size in case of early stage startups is 10 to 15%, and in this stage, generally the company will be in a stage where it is developing a product. So the key heights to whom at this stage are like product development team like CTOs and CXOs. Those are the key hires to whom the ESOP options are given mainly in this stage. So product development team will have more options when compared to other teams in this stage. And Series A and Series B, now the product is established and you have already incentivized your product development team. Now it wants to market its product, it wants to build sales. So now you will be concentrating on incentivizing your sales and marketing team. So these are the few teams where Series A, like in Series A and B stages, you will be concentrating more on sales and marketing team. And growth stage startups, you would generally see a growth stage startup would give to almost all the departments, but like every company would follow a practice like support functions like finance and HR would not have much say in ESOPs because they would not directly impact the performance of company. That is all across all the years, because the finance team and HR teams would not have much say when it comes to employee stock option, because they feel that we can't directly impact the value of the company. But growth stage startups, almost all the employees will be able to eligible in case of a growth stage startup. Is everyone clear, right? How? Now we'll move on to the regulatory part of ESOPs. So, at what stages income tax would get applicable in case of ESOPs? Exercise. One stage is exercise and other stage is sale of shares. So at the time of exercise, as per 17 subsection 2 and 6, clause 6, the shares would be taxed as perquisite, and when the shares are ultimately sold, it will be taxed as capital gain. However, in case of startup, there is an exemption where the taxation is delayed. It will not be at the time of exercise, whereas it will be at the earliest of 3 days, which is 5 years from the date of grant, or when the employee is selling shares, or when the employee leaves the company. This is available only for the startups who are registered under as per DPI. So how do you value the shares, or when you are taxing as per perquisites, how will you value? Like someone was asking, right, like how do I tax it? So there are valuation rules under which are prescribed under Income Tax Act. Rule 3 provides these rules, saying that if you are a listed company and your shares are listed in a stock exchange, it would be average of opening price and closing price on the excise date. Whatever is the average of opening price, on that you need to pay taxes perquisite. If your stock is listed in more than one stock exchange, then you need to consider a stock exchange where the highest volume is being traded. However, if there is no trading for your stock, then you would take last closest date to the excise date. Whatever is the closest date to the excise date, what is the last trading price, that price would be the value for taxation. Whereas when it comes to unlisted company shares, it has to be determined by SEBI certified merchant banker.
This merchant banker certificate, how long it can be valid? Yearly once is enough?
6 months.
6 months.
Yeah, exactly. Like in case of listed company shares, there it clearly says that on excise date you can take the value and you can tax it. Whereas in case of unlisted companies, it says that specified date. On a specified date, you need to take the value of the company and you have to tax it. What is specified date? Specified date is nothing but it should not be older than 180 days from the date of excise. Like the valuation date is 180 days. However, now is everyone clear with taxation with respect to, right? So how are stock appreciation rights taxed?
That's a salary.
Okay. But in case of stock appreciation rights, which are given as like in as SARs, which are given as shares. Stock appreciation rights which are given as shares. Those again will be taxed at in par with ESOPs only. However, which are realized in cash, those will be taxed as salary. So, will ESOP expense be a deductible expenditure on an income tax act?
Yes, based on bylaw.
Yeah, exactly. So, why there is litigation of all this is like the next two questions will answer the question for second one, because whether ESOP expenditure is a capital or revenue expenditure. First of all, it is a revenue expenditure. Why there is a contention of capital expenditure?
Because there is a huge.
Yeah, correct. Sorry. You-
I think most of normal expense is like a portfolio stuff.
It is a capital asset, and that's why there is a contention that whether it is a capital expenditure or revenue expenditure. But since the benefit which is being given is for the services rendered in the course of employment, and that's why it is treated as revenue. It is being concluded by various courts that it is revenue expenditure. And there have also been multiple contentions where it is told that it is a contingent liability. Income tax officers have told that it is a contingent liability because you are not able to determine the liability upfront. So how are you able to take the deduction before only? So, but various courts have again ruled that it doesn't, since you are not able to determine the liability, it doesn't make the liability as contingent liability, and they have allowed that it is a crystallized liability and you can take the expense. And also one more thing which creates a doubt, like why ESOP expenditure can be a capital expenditure. Can anyone tell why ESOP expenditure can be a capital expenditure?
Because the underlying is a stock.
Underlying is a stock, and also if you see when ESOP expense is being reversed, let's say I created ESOP expense over a period of 3 years, and I based on vesting all the employees are vested, but at the end of the day he is not exercising, which means that I have to reverse all the expenditure and it goes to general reserve, which makes more complicated that okay, when I am reversing the ESOP expense, I am crediting the general reserve and not P&L, because it is related to past years, and that's why it is a capital receipt. When you are reversing the expense, you are saying it is a capital receipt, and when taking the expense, you are saying revenue expenditure. Let's say over the vesting period, I will take the deduction and I will hit my P&L. And when employees are not exercising, I have to reverse that expenditure. And when I am reversing, what I am doing, I am not taking it to P&L. As per accounting standards, I have to credit to general reserve, which means a capital receipt. When you are reversing, you are treating it as a capital receipt. When you are taking deduction, you are taking it as a revenue. This again creates a contention. Why can't ESOP be treated as capital expenditure when you are reversing expenditure, you are treating it as capital receipt?
But reversal taking as capital receipt, is it incorrect? Because when we are reversing, ideally it should pass to P&L, right?
Yeah, but there is one provision where it says that you have there are adjustments, like if you see in tax audit report also, incomes which are in the nature of capital expenditure, they will have there you have to insert the ESOP expenses which are being reversed.
And also as per income tax, it gets allowed only when it is paid, right?
When it is paid in a sense.
Exactly. Sometimes we make ESOP provision, but once it's exercised, then only it's allowed, right?
Yes. No. As and when it is vested, like let's say I created expense over the vesting period. Let's say I granted some 100 options, and it will vest over 4 years. So every year 25% of the options will get vested, and I can claim expenses to the extent of 25%. I need not wait till excess period to claim the deduction.
Like suppose when we are issuing shares of the holding company,
Okay.
and it gets paid to the holding company after 4 years, when it gets exercised.
Okay.
So at that time, as per income tax, it gets allowed only when it is paid to the holding company.
But let's say in that case, I will be creating expense provision over the 4 years.
Right.
So expense provision, expense deduction would be happening, will be available only by the company which is creating the provision, right? Like subsidiary company would be creating provision all the 4 years.
But
There is
then
no
we
risk.
will be getting the reduction in income tax. It is only at the time of payment, not at the time of profit.
No, that's what you need not wait till excess of shares to take the deduction benefit.
I think it is disallowed, sir.
It is disallowed. So
I think it is disallowed.
industry
There is a
practice is
deferred tax.
like that. Again, I am not sure.
No, it is not. It is nowhere disallowed. You need not wait till excess date to claim the ESOP expenses. You can claim as and when the vesting is.
ESOP, in any case, are deducted from the reserve, it's not charged to P&L.
Because Indians has also come like any prior year expenditures, if you are supposed to reverse, you have to reverse it retained earnings and the P&L. That's the India's requirement.
Yeah, but whatever the requirement is, and you are treating it as a capital receipt, right?
Right.
It can be reversed in P&L if the employee resigns before the vesting period.
Correct.
Only if it is after the vesting period, then as
No reversal is possible.
Yeah,
Reversal
because
is
it
not
will be
possible
a
if it is after vesting. See,
Yeah.
in forfeiture post vesting,
Yeah.
there is no reversal.
Yes.
And also, if the employee to whom the ESOP is given is predominantly working on a development of a product which is capitalized, so will the ESOP cost also go to the capitalization, or can you say it is?
No, it will be treated as employee. It will be a revenue item. Like even if you give instead of ESOPs, if you are giving cash, you would not say that okay, this salary is related to this calculate, and I will not calculate.
No, is it
If it is a salary.
is it the option you can capitalize or I mean you can deduct from reserve or P&L, or it's only P&L?
It's only P&L, there is no option. If you don't debit to your P&L, you are only going to lose out on taking deductions.
No, people don't want to deduct from P&L because it's huge, no? MD and all, they get crores in thing. So it is charged from reserves.
You would create reserve at like how the entries flow in case of while taking expenses, employee benefit expenses to ESOP reserve. Each year I will create reserve, and at the end of the after completion of exercise, after completion of vesting period, at the time of exercise, I will reverse my ESOP reserve to share capital. So all these years I would create employee benefit to reserve 25 rupees, employee benefit expenses to ESOP reserve 25 rupees. I will create a reserve 100 rupees till excise given. At the time of excise, what I will do is ESOP reserve to share capital 100. It will matching concept also will not work out unless you debit to P&L. From accounting principles also, if you see, it is not right to directly debit to your reserves.
So maybe when you are doing first time adoption of Ind AS and you are restating your 2 years grants given 2 years back, and you are doing maybe FY23 and FY24 restatement, maybe those will obviously go through reserves because the P&Ls are closed. But going forward, you are right that it has to go through P&L. There is no option of going through OCI or going through reserves.
Yeah, I'm not well versed in first time adoption of Ind AS, but it might be true. But I can
But
check
otherwise,
it.
yeah, it has to go through P&L.
Yeah. So, is everyone clear with respect to the direction, taking direction, right? The next one comes to whether presence of employee and employee relationship is needed for income to get taxed as salary. So first of all, why this question has come? Like yeah, exactly. Like there will be one foreign company. Like this is very common scenario where foreign holding company will be there, and it will issue ESOPs to employees of subsidiary. There, though there is no direct relationship between employer and employee, whether it will be treated as salary because there is no employee. So what courts have held is it will be treated as salary because you need not see where the consideration is coming from. You should see whether what they are paying for. They are paying for the services which you are rendering in the course of employment. That's why it is treated as salary. And next example is little interesting, like where a foreign company is there, let's say Microsoft Inc. And there is one foreign employee who is working for Microsoft Inc. And he has been on a secondment to India. And he has exercised his shares when he is a resident in India. But all these days, when vesting has happened, he has worked in US and he has been on a secondment and he exercised his options in India. Now whether it is taxed in India or not. All vesting has happened there. Vesting in the sense all the conditions he has satisfied for gaining those options in US. However, exercise is happening, only exercise event is happening in India when he is a resident in India, whether it is taxable or not.
Due to accrue or arise in India, he is working in India, so it's
Cycles of shares, you can say that.
compensation is linked to accrue or arise. Any income which is linked to accrue or arise in India is taxable in India.
Yeah, but it is not logical. Like I worked for last 4 years, for which I am getting the ESOPs. I worked in US itself, but it is unfair, right? I worked for US company and I earned that options there, but however when I am exercising, I am just a resident in India.
So during vesting period, where they do, that should be the country of taxation. And then you get the credit wherever you are the resident during the exercise period.
So there are multiple views, like irrespective of where the vesting, like let's say he has provided service there, but he is getting here income here. He is not getting income also here. He is just a resident in India when he is getting income. That's not fair, but courts have interpreted that it is taxable in India. Few courts have also interpreted that, suppose let's say 2 years he has worked there and 2 years he has worked in India and total vesting period is 4 years. So they told that they concluded saying that 50% you tax in India, 50% you tax outside India. So there is no Supreme Court or High Court judgment which concludes this view, but it is still a grey area and it can be still fought. Yeah, so now what is the taxation in case of issuance of ESOPs by Indian holding company to employee of overseas company? Let's say HDFC Bank is there. HDFC Bank has given to an employee of HDFC Bank UAE. Will it be taxed in India?
Not taxed.
Be taxed in India.
Sorry?
Not taxed in India.
Then logically if you see it should not be taxed, but courts have again ruled out in favor of department itself, the income tax department, that it will be taxed in India.
So you're saying this from an employee perspective. Will it be taxed as an Indian income in the hands of the employee? Is that the question?
So what is the basis? Because income is not accruing or anything, it's just an issue of shares similar to what we are doing it for STI.
The reason being they are part of the same group. That's what the major reason. It is actually happened in case of HDFC Bank itself. The case which I am telling, it has happened.
But if HDFC Bank pays salary to that UAE employee, obviously the UAE employee is not getting taxed in India because he's getting his salary for the services he's providing in UAE. But why is it that for ESOPs he has to pay tax?
But salary also it is very contentious because he is received. If it is received in Indian bank account, then it is going from India. Then it should be taxed in India also.
No, it's not in India. Not taxed in both the countries.
Sorry.
There are taxed in both the countries.
It can. There is no such rule that it has to tax. It can take DTW benefit.
You have to go for a DTW.
That's right.
See, I have handled a case of Nokia, where Nokia incorporated shares are being given to an employee working in India. So it is taxed there as well as it is taxed there as persecuted. There they deduct the TDS, then you claim that this credit and go to BTK and claim from Finnish government. And it comes very fast. Within, I think, 30 or 60 days, you will get the credit.
Exactly. You are mentioning.
On the salary part, even if the salary, the services rendered in UAE. So because the services are rendered in UAE, you can say it's not rendered in India, even though paid in bank account of India. There are rulings to say that it will not be taxed in India.
Yeah, there are either in either sides there are rulings that it can be taxed and it cannot be taxed. You mean to say when salary is being disbursed in through cash, right? Yes, sir. And one more income tax aspect with respect to ESOPs is whenever shares are being exercised, it is getting taxed as perquisite, right? So ultimately they need to deduct TDS on perquisite. So that is another responsibility on employer to deduct TDS on perquisite under 182 section. So now we will see what are the common mistakes which we have come across during our ESOP assignments. So I will discuss few things so that it will not, which the companies have made while formulating ESOP policies or implementing. So I will quickly run through because we are running short of time. Let's say in policy and documentation, like SHA says some number and whereas you are actually issued some other number. This would create a direct impact on valuation of the company also. And conflicting clauses in policy and absence of important clauses. Like one clause says ESOPs will be given in cash and other clause says ESOPs will be disbursed in shares. And other one would be absence of non-solicitation and non-compete clause in employee agreement. Why this is needed is non-solicitation, everyone knows that when an employee goes out, he should not solicit business from the existing employer. So, and non-compete, he has to not compete in the similar business for next 3-4 years. So, all these clauses are very important to have in employee agreement as well and also ESOP policy. The same should be continued in ESOP policy. And in few cases, grants will be given without getting it signed. And the last one has a very big impact, like hard coding equity commitment values. Let's say when I'm having ESOP employment agreement, I will say 10 lakhs I will pay you in cash and employee stock options I will give you. You should leave to the extent that I will give you 100 stock options. You should not tell I will give you stock options worth 1 lakh. Because you don't know the value of your stock options at the time of exercise or at the time of when he exercises shares. So when you are committing a value in the employment agreement itself, it would commercially, it would impact and it will lead to legal disputes. And all the employee laws are very favorable to employees. So you cannot hard code and commit a value in the employment agreement saying I will give you employee stock options worth 1 lakh or 2 lakh or X amount. You could just say how many options you are going to give. When it comes to management, improper delegation of authority, like we should ensure that board, like every decision cannot be taken by board, right? It will be creating procedurally it will create longer time. So we should create an ESOP committee where it has one board of director and HR from HR head should be there in that committee and they should manage ESOP. And granting options to non-employees or employee agreement date is let's say today, however grant date is yesterday's, that is on upfront it is very really wrong. And ignoring acceptance deadlines, like if he has to accept the grant letter within 30 days but he is accepting after 45 days and still the company accepts that, all they should be avoided from legal point of view. and care should be taken while information is given to valuers, because if you give wrong number of stock options which are issued to valuers, so they will value a wrong expense amount and it will be accounted wrong, incorrectly, and also it will resultantly impact your deduction also. So you should ensure that whatever information you are giving to valuers for accounting purposes or for tax purposes, you should ensure that the information which is shared which will align with SHA as well. And you should also, and we have seen few cases where special resolution is not being taken when ESOP size is more than 1% to a single employee. So Companies Act says that if you are allotting more than 1%, you have to pass special resolution, but you are not passing that. And ambiguous liquidity event, like we already discussed, right? Liquidity event should be a value realization event. It cannot be a simple, like if it is a, let's say you left it open, saying liquidity event as capital reduction or merger which has no valuation. If you are saying liquidity event as a capital reduction, and if employees are exercising on that event, company is not getting any cash, right? And in turn, it cannot give that cash to employees. So liquidity event should be some cash realization event. And the power of attorney should be given to directors. This is for the voting purposes, like how other minority shareholders give. Employees also are recommended to give power of attorney so that decisions can be faster. I'll quickly go through the Companies Act compliances. So firstly, as per Companies Act, you should ensure that your AOA has a clause for issuing ESOPs. That is the first check. And can ESOPs be given to promoters of the company?
No.
No. Are there any exceptions? Yes, thank you. And does Companies Act allow for excise price to be nil? This we already discussed. It can be nil. And once ESOP policy is approved, can it be modified?
Yes.
But if it is affecting negatively the company, can it be modified?
It can be. If it is beneficial to the employees, it can be.
No, it is other way around.
It can't.
No.
But in days 102 allows you
for modification.
Yeah, but here Companies Act says that it should be available. And is there any minimum vesting period? That we already discussed that cliff should be 1 year. And can there be any lock-in period as per Companies Act? Yes. What documentation you need to maintain SHA?
There's only a minimum 1 year. After it's vested immediately, you can sell. There's no lock.
After 1 year, there is only minimum vesting period of 1 year. After that, you can give entire options, all the options to employees.
So, question of apply, can there be any lock-in period? There should not be a lock-in period.
Can there be any lock-in period prescribed for transfer of shares? Yes.
There is no lock-in period. You can immediately sell after the 1 year cliff period is over.
Vesting period is different from lock-in period. Lock-in period is after he gets the shares. Vesting period is still it is in option stage only. Lock-in period is after he exercises, he gets the shares. Can I have a lock-in period saying that okay, you cannot transfer the share to any other person? Can I have that lock-in period?
You can't.
I can have. Companies Act allows you to have allows the company to prescribe lock-in period.
But that 1 year period is not there.
1 year period is they can't transfer options to anyone. That is there. 1 year vesting period is you cannot give options within a year. Can a company provide loan to purchase its own shares?
Yes. We saw that. Yes.
Yeah. Generally, as per section 67, it is not allowed to. It specifically restricts company to give loan to purchase its own shares. with an exception saying that employees can take the loan from company. Are the options provided to employees transferable to any other person?
Generally, they will not. It's other than they die, it will be transmitted.
No, it is not. Options are not transferable.
If they die or in eventuality.
Yeah, it can be in case of death, it goes to nominee. However, company can buy back the options. So we'll quickly see the FEMA practices in relation to cross-border ESOPs. This is where when ESOPs are being issued by Indian holding company or Indian holding company to foreign subsidiary. So this is like this is FDI or ODI. Like Indian company is issuing shares to foreign employees.
It's FDI.
FDI, correct. So in case of FDI, you need to follow certain rules and regulations which says that whenever a sectoral cap is required, like few sectors have sectoral cap, like let's say e-commerce business, marketplace business has restriction of 49%, or banking business has restriction where only certain percentage of FDI is allowed. Or if you are having more than certain percentage of FDI, you need to take approval. So all this would apply in case of ESOP also. Like whichever some sensitive sectors like atomic, banking, insurance, all those sectors where RBI approval is needed, the same has to be obtained in case of ESOP as well. And whenever you are issuing to employees who are in Pakistan or Bangladesh, you need to take again approval. The forms which are to be filed is when you are issuing options, you need to file form ESOP, and when you are allotting shares at the time of exercise, you need to file form FCGPR. Now, when it comes to foreign companies issuing shares to Indian employees, this is ODI. So there is only one major condition in case of ODI, which says that whatever ESOP policy that foreign company is framing, that should be uniform for all other countries as well. Let's say a US holding company has some 3 subsidiaries outside India, Africa and Australia. So all the ESOP policy which is being framed for all the 3 countries should be uniform. And the forms which are required to be filed in case of ODI is form OPI. OPI is where the percentage of holding is less than 10%. Then you have to file form OPI. And in case of ODI, when the percentage of ESOP is more than 10%, then it is ODI. Then form FC is required to be filed with RBI. These are the only conditions when it comes to FEMA when cross-border transactions are happening. And when you are investing in other companies, like when foreign company issues shares to employees of India, there is one more responsibility under FEMA for Indian employees, which says that you have to repatriate whatever proceeds you get from, let's say I being a Microsoft India employee, I am getting shares of Microsoft Inc., which is in USA. I got options and I got shares. I have to repatriate the proceeds and I have to get it back within 180 days from the date of realization. So that is one repatriation responsibility which the employee will have.
He can actually reinvest also.
Reinvest also, yeah. He should not keep the funds idle outside. And when you are exercising shares of a foreign company, you need to, and if there is an excise price, let's say there is an excise price, how will you make the consideration? Is there any approval required? When like I being an individual employee, at the time of exercise of options, I need to make some excise payment. I need to make the payment of excise price. When I am transferring the amount, should I take some approval from RBI to transfer that amount? So it comes under LRS. LRS limit is up to $250,000. So till that amount you can freely transfer amount to outside India. And ESOP fairly covers under LRS. And one more aspect, when you are doing any transaction under LRS, TCS also gets applicable. Like whenever there are limits where you are transferring 10 lakhs, it will be nil, TCS will be nil. Wherever you are transferring more than 10 lakhs, it will be 20% TCS. So that's the end of the session. So if anyone have any questions, quickly take 2 minutes.
Any taxation on companies, there was one clause where if the company startup issues less than FMB, then they have to pay the tax. Other than that, is there any tax for the companies for ESOPs, granting of ESOPs?
No, there is no.
There was one clause, no, if the company startup issues the ESOPs at less than FMB, then the difference they have to pay the tax.
No one has any questions?
One second.
Be seated, no? 2 minutes, just thank the speaker. Yeah.
Thank you for the wonderful session and providing valuable insights. Please give him a huge round of applause. We, the managing committee members of Bangalore branch of ICAI, on behalf of all the members present here, appreciate the time and effort to disseminate the topic and discussion. As a token of appreciation, I request the chairman, Mr. Manjunath, to honor the speaker by handing over the memento. We thank each one of you for your support for Bangalore branch. I request all the members to kindly follow ICA Bangalore YouTube channel and Bengaluru branch WhatsApp channel. Thank you members for joining us today, and we'll see you next Wednesday. Thank you one and all.